There are risks and costs to action, but they are far less than the long-range risks of comfortable inaction.
This is SPRH Podcast, where business experts help you to take massive action. With your hosts, corporate and keynote speakers Matt Ward and Dan Candell. Change your business, change your life, and start now.
Hi, and welcome to the SPRH Podcast. I'm Dan Candell here with Matt Ward and our special guest today. Matt, there's this guy named Sam. Now, not the guy we had last week on the podcast, right, but another guy named Sam, and he's an asshole.
Sam I Am?
Money. Not Sam I Am. He's an uncle. He wears red, white, and blue a lot, and we both pay him a lot of money. He's a jerk. We keep paying him. We don't get anything back.
Yeah, but, I mean, you don't get much back, but, I mean, you might get a wall.
We might get a wall. We might get a wall. That's true. We might get better highways, right?
Or healthcare.
We might get those things. Well, you know what? Let's jump into it today because our next guest today is going to talk to us about how to plan for when Uncle Sam comes, hopefully not banging on your door. He just sends you that nice little envelope that says, you owe us this much money. So please help us welcome our special guest today, Matt Zepka. Welcome, Matt.
Thank you. So happy to be here and looking forward to chatting a little bit about Uncle Sam himself and how we can keep him from knocking at your door.
Me too.
When it's good. And interestingly enough, sometimes you want to give him a little so you don't have to give him more later, or we want to give him none now and still give him none later. So
there you go.
Some of the beauties of the text.
And I've got a real life Uncle Sam. But we're not going there right now.
Poor bastard.
As you know, Matt, we help small business owners take massive action. Can you share with our listening audience what massive action you have taken and what the results of that massive action were?
Yes, absolutely. Massive action, if you're listening, would be understanding that preparation and planning are two very different things. There's a big assumption out there right now that your CPA, your accountant, your tax preparer, whoever it might be, is trying to solve the problem for you and have you pay less taxes. That assumption is incredibly incorrect. Everybody is out there doing taxes and very few people are planning for taxes. There is planning that goes on. You know, the old 80-20 rule always talked about used to be 80% preparation, 20% planning. In the 20 years I've been in this business, that percentage is shrinking. I would say it's 98-2. There's not a lot of planning going on in the world. And if you're not doing tax planning, you're missing out and likely losing tax dollars to the government.
Matt, is the reason it's shifted into a greater minority, 80-20 to 98-2, is the reason it shifted that way is because it's gotten more and more complex and the tax code changes all the time. And so people don't know what to do and they're running around last minute calling the tax guy or the CPA at the last minute. Is it the business owner's fault that this is shifted into this role?
You know, the complexity plays a role. The funny thing with the government and the legislators and how they put change in effect is they always talk about simplicity. It actually turns out being complicated, more complicated than it was before. So that's part of it. And a lot of it is a communication gap. Unfortunately, if you're talking to an accountant or CPA and they don't have a good way of delivering the information to you in an understandable format, you may be frozen from taking action just because you're like, what the hell did he just say? And you don't know what to do. And furthermore, a lot of accountants and CPAs business models are not designed for planning. So they're trying to do it, but they don't have a good executable system that you, the business owner, or you, the taxpayer, can say, hey, I like that. I want to do it.
Every single year from my CPA, I get this tax planning guide. It's like this whole guide and this big packet that he sends out and everything like that. And it really does help. And it really does. It's almost, it's hard to describe it. It's a tax plan.
How much does the guy weigh?
How much does the guy weigh?
He sent you a tax planning guy?
I wish he sent me a tax planning guy. He sends me a tax planning guide.
Like a book?
Yeah, book. Like
you're gonna read that?
No, it's like to structure things, to plan. And
so when do you get that packet, that guide?
I get that usually around, I would say June or July.
Okay.
Yeah, so
what do you do
it's
with it?
fairly early. It just helps you. It's almost like a chart of accounts where you start putting things down, and they want you to, it's basically like as the years going by, they want you to keep it in mind to say, listen, this is going to come a lot quicker than you think it is.
Okay, but that's what you're supposed to do with it.
That's what
But
you're
have you
supposed to
done
do.
with it? It's a paperweight for you, isn't it?
I've wiped my butt with it when I ran out of toilet paper.
You don't use it.
No, you don't.
Is this the problem, Matt?
Well, I will say one benefit to that's probably an exception to the rule. Most of those packets don't come out until January because it's more focused around preparation than anything else. So it's, hey, you, the taxpayer, put your stuff in this order, check these boxes, answer these questions so that we can prepare your return based on what you're providing. So not a lot of people are sending out a planning packet, but that's transferring the action required to you, the taxpayer. And if you don't know what action needs to be taken and it's not clearly laid out in that packet, it's still not going to do any good. But that is a good thing that that's coming in June. Half the battle is changing the mindset. Everybody thinks that when you're doing your taxes is when you can have the most impact on your result. When in actuality, all the impact you're going to have is going to happen between January 1st and December 31st. Once the new year rolls, most of your options are gone. There are some things you can do from a tax planning perspective, but they're very minimal at that point. Everything happens while the calendar year is open because you have the choice of what action you can or are willing to take to have a change or an impact on your outcome.
Okay.
So what do I do?
Well, let me ask another question because didn't prepare. Let me just cut Dan off because I know he's got good questions, but I got so many questions. Let's just say we didn't plan. And now we get to January 1, and now we realize, okay, I'm going to owe a bunch of taxes. Maybe because I haven't done my taxes yet, but I realize I'm probably going to owe a bunch of taxes. And January 1 is usually when the radio ads start for the commercials that say that you can negotiate your debt with the IRS. I hear them all the time. It's in this 4-month window, right? Because they're preying on people that owe money because they didn't plan properly. First of all, are those things even legit?
Yes. So what those are a very unique part of the tax code. It's called an offer and compromise. They market it like everyone and their brother qualifies for that option, when in reality, very few people do qualify. When you have a tax debt and you have no assets, that's really when that comes into play. Because if you fill out the questionnaire and you say, hey, look, I owe you money and I already don't have any money, the likelihood that they're going to collect on you is very low. So they're willing to make a deal with you. If you've got assets and you've got a business and you've got savings and you've got real estate, they will never let you go because they can attach to all of those things if you try not to pay them. So the offer and compromise sounds really awesome. And they do make some pretty sweet deals, but oftentimes it's people who are either have no money, have no assets, or are severely in debt to where their debt exceeds all the assets that they have. The IRS will negotiate in those situations. There are people, so that's a completely separate arena altogether. There are plenty of businesses that do just tax negotiation. That's all they're out there doing. They don't prepare taxes. They don't do planning. They're just saying, hey, hire us. We'll fight with the IRS and try to get the best deal that you can. And there's a lot of that crap going on.
The key is to never be in that position, to plan accordingly in advance.
Exactly. And with planning, it's interesting. A lot of people think you have to cheat to win at taxes, and it's not true. There are a lot of benefits and strategies and things you can put in place that are right in the rule book. The thing is the rule book is so big and so few people are good at communicating what's in there that people don't know what rules to play by. And so that's really kind of step one, is you got to figure out, okay, where am I at? What rules am I currently playing by? And do I need to change the game? Maybe I'm playing football and I need to move to baseball because the rules are better. Something silly like that. I compare that to your entity. What structure do you have? And you may want to change from your current entity to a different entity, or combine and use multiple entities at the same time to try and have better fluctuation and control over what's going on.
So when you're talking about planning, you say it's about 98% planning. What do you mean by planning? Do you mean just taking money and putting it away, becoming aware of what your expenses are already? What are you talking about planning that we can do throughout the year, that 98%?
Yeah, so planning is really two different buckets of strategy. So most of what goes on in the world, that 98% is preparation. Literally, in my opinion, there's only around 2% of people that are doing high-level planning and talking to you about what to do. The first round of planning is really, where are we today? What's the assessment and what's the prescription today of what we're doing, and can we get better structurally? So that entity decision, how are you paying yourself? How is that wage being taxed? Are there ways to control how it's being taxed? Really structurally and legally, what can we do to get better? That's kind of step one of planning. Step two of planning is then each and every year, you want to figure out where you're going to end your year with income by the time the new year rolls. Because let's say it's December 15th and you say, all right, here's what my April 15th is projected to look like. If you don't like those results, you have 15 days to take action on what you can do to try and impact that. And now every business has different action items as a potential thing to do, because it depends on how you're structured, whether you're cash basis or accrual basis. That's something that gets confused a lot of times. Cash basis is very simple. I pay taxes on money that I've received, and I deduct expenses that I've paid. It's that simple. From a tax planning perspective, if you're cash basis, you want to make sure you've paid out all of the expenses that you absolutely can pay by the end of the year, so that you're getting the deduction against whatever income you have. So that's one of your control mechanisms. Accrual basis taxpayers don't have that choice, because they have to match up revenue and expenses to the periods that they belong, regardless of when they're paid. So if I owed somebody and I didn't pay them until February, but I did the work or the service in December, it would be an expense in December on the accrual basis, but not paid until February. Does that help?
That helps. And the growth goals, like a lot of us have pretty ambitious growth goals, and then there's what's going to happen realistically. And when you go over the year in review and you say, okay, this is what the upcoming year is projected to look like. And let's say you say, okay, we have a certain amount of money set aside for that. But let's say those growth goals don't pan out, and then you end up owing all this money because you haven't gotten to where you wanted to be. I'm just trying to think about this in experience of other people that I've talked to. They've had these really ambitious goals, so they've invested a lot of money, which may or may not be considered business expenses, and they still end up owing all this money in afterwards, even though they didn't meet those growth goals. And it's like they're always playing catch up from previous years.
Yeah, once you get behind in the tax game, it can be a long chase to get caught up. So when you're spending money as a business owner, you want to be extremely careful to be assured that it's a currently deductible expense. So a tax trap, kind of like you just explained, if you're having a great year and you're making a lot of money, it all depends on how you pay your taxes as to whether how much of that money is actually yours. So if I don't pay my taxes until the end of the year, I might have money at my disposal that really isn't my money, because I eventually have to pay it at the end of the year to the government. Well, let's say I went out and bought a rental property because I wanted to expand my portfolio and I paid cash for it. Now, paying cash versus financing, whole separate conversation, but I just used pre-tax money to make an investment. So I'm going to be cash poor when it comes time to pay my taxes, and it's going to be a smack in the face. I owe what? I don't have that money. Well, if I spend it ahead of the tax schedule that I had to pay it, that's how you can wake up with those surprises. So I highly recommend, if you're going to make a significant investment of cash into any program, asset, expense, whatever you think it is, making sure it's fully deductible, or how you're going to realize that benefit, is critical to make sure your cash flow doesn't get turned upside down.
Matt, I also suspect that another tax trap would be, especially for solopreneurs, entrepreneurs, and small businesses with just one employee or two employees, would be not paying their estimated taxes. Right? Because not paying that means that they're going to need that cash at the end of the year to pay the tax when they didn't pay it each and every quarter along the way, right?
Yeah, I'm a big fan of isolation of funds, making sure I know what funds are going to end up where, saying, all right, well, I mean, as a basic rule, you really should be putting 30% of any true profit that you're making in a separate account to at least have a chance at funding your taxes. Now, depending on your income level will depend on how high or low that percentage needs to be. But I'm a big fan. So there's a safe harbor rule in how you pay your taxes. When it comes to estimated payments, the default by most accountants is, look, we're going to take the prior year, and you're either going to take 100% or 110% of what your total tax was. You divide it by 4 and you make 4 payments. Well, sometimes that's really terrible for someone's cash flow, because if you have a fluctuating income, you might not have enough money to make those first two payments if you make a lot of your money in the second 2 quarters of the year. So it puts a lot of burden and stress on you to come up with that. There is an actual method. So you can say, all right, how much money have I made so far? And I'm going to pay in based on how much that I've made. Very few people follow that protocol, but it does help match your tax payments to your cash flow so that you're not ending up in that bad spot from not paying any estimated payments at all. The best way to make tax payments from the IRS's perspective and from a penalty perspective is through withholdings. With estimated payments, there's a lot of rules: when you pay them, how you pay them, what the amount is. If you pay your taxes through withholdings, which would be on a W-2, you can pay them all on the last day of the year with a big bonus check, and it's like you paid them equally throughout the entire year. So there's a lot of different ways, once you understand how to structure some of those tax payments, on how to get it done. But again, you got to have the money available to accomplish those tasks if you set it up that way to do it at the end of the year.
So withholdings doesn't actually mean you're withholding it throughout the year or paying it throughout the year. It just means you're theoretically withholding it throughout the year, and the payment is made before January 1.
Yeah, so in a situation where you do a bonus check to cover your withholdings at the end of the year, it gets withheld on December 31st. It gets transmitted to the government sometime in January, and then it shows up on your W-2. For the average employee, it is happening equally throughout whatever pay period structure they have. When you're a business owner, you have control over that. You may still be getting a paycheck throughout the whole year, but we reserve a portion for a bonus to say, hey, we know we've got to pay our taxes. We want to wait and pay them with withholdings, and we're going to do that with a bonus check to make sure we had control of as much money as possible throughout the year.
One of the things that in its discipline, am getting disciplined doing is at the end of every week, going and looking for what my cash flow was and what my income was, and taking a percentage of that and putting it in that separate account. So, because I've been caught in that trap before, when I'm like, ooh, I have 10 grand in my bank account. Like, this is great. But that's not all my money.
Latte in Vegas.
But that's,
yeah.
But
Dan, I did the same thing.
That's not all your money.
When I switched businesses this year, I did the same thing. I was like confused because I was doing withholdings on, even though I owned the web company, I was an employee. So I was getting a W-2 and I had withholding. And then I did the same thing. I set up a tax account and started moving it every week now.
Yeah, I'm a big fan of multiple accounts. Having a tax account, having on a household level for a personal setup. I have a household account. I have a checking. My wife has a checking, and even my kids have a checking. Specific amounts go into those accounts, and everybody knows how much they get. So it's very easy to manage and know what's going on, and the taxes just accumulate so that when it comes time to make estimated payments, the money's just sitting there waiting. So you don't even have to fret about, hey, where am I going to find the money to make this payment? And number one, it just sucks making estimated tax payments in general, because you write those checks and they just make you want to vomit.
Man,
that's so true.
That's true. Do you sometimes feel like you're a therapist too, or like a crisis intervention manager? Because I can only imagine people come in and they're probably not some of them probably aren't very happy when they leave.
Yeah, it is an interesting dynamic to manage the taxes. That's one of the things and why we preach planning so much. I've been in way too many situations that were out of my control that, people drop their stuff off March 25th. And then we've got 10 or 15 days to do the return. Well, they didn't communicate with us all year. We didn't have any idea what the heck was going on. And then we find out they sold 3 of their investments and that they owe $100,000 in tax. We have no idea if they understand what is potentially coming in delivering that information. So you have to get very good at delivering what could be potentially devastating news to someone who may have an idea or may have no idea, and they may know, hey, I sold these assets, but to really capture what the tax ramification could be, they might think it's 20 grand and it ends up being 100, because they didn't plan ahead of time to know, okay, what does that look like?
Right.
And isn't also this a discussion that they should be having with you prior to selling it, saying, I'm thinking about selling these assets. What are the tax implications of doing that?
Absolutely. You always want to know what your net is if you're going to sell something. So if you have a loan against it and you got to pay taxes, how much am I going to walk away with? Because that's part of the decision you should be looking at is whether you should sell it. Are you getting the right price? And is it going to work out to where you're going to walk away with a number that's reasonable enough for you to get the right return on investment? So yeah, you always want to know that ahead of time. And that's kind of that phase 2 planning there. You should do a projection at the end of each year. You never want to be sweating what April's going to look like. You should know ahead of time. I had a call a couple of days ago. There's a pretty big balance due for one of the clients we're working with, new client. They'd never done a projection like this before. We went in and we projected some numbers. So the first thought was, well, hey, this can't be right. So we're going to look in, we're going to research, we're going to go with what's going on. We found out that it was right. But now, instead of finding out 2.5 months from now and scrambling, they've got 3 months to plan on their cash flow to figure out how to get the liability taken care of. So having that advance notice of bad news is step one. And if you do it soon enough, and sometimes there's nothing you can do. Sometimes it just is what it is based on the environment. But if there is things we can do, we can at least put those actions on the table for you to consider to say, okay, which of these makes sense? What cash do I have available? And how do I capitalize?
And Matt, I want to recognize this. A lot of people think that my accountant is someone that I go and visit and have a conversation with once a year. And that's why, to our listeners, you want to have a CPA, an accountant. And Matt Ward has told me many times, I've called and had conversations with Matt and with this firm. And this is, you want to start to build a relationship with.
Yeah. So just for clarity, I work with Matt Zepka and his team for my taxes and throughout the sale of my company. So yes. So just for clarity, when you're saying I called Matt, I didn't just call myself. I just,
you've been known to do that.
From time to time, but it wasn't the case in this situation. Yes. Yeah.
But you want to be open with your accountant. You want to have conversations with them throughout the year. And if there's any shifts or changes that you're making in your business, this is really important to address. And I've had accountants before this specifically told me, I don't want to talk to you throughout the year. I just want, just come in once for a half hour. And that's what screws people.
If you have an accountant tell you they don't want to talk throughout the year, I would run as fast as you can run.
I did.
That is a horrible answer.
Yep.
You absolutely want to be building a relationship and some rapport. So one of the things we did about 10 years ago now that's been a real big game changer, what we found is clients wanted that, but with the unknown nature of how most professional firms, whether it be legal, accounting, whatever, are set up, most of them are hourly. So the conundrum was, well, what is it going to cost if I call? And then I go in for a meeting, and then it's another meeting. And so this unknown factor of cost just prevented people from calling. They just try to figure it out themselves, or they'll just, I'll deal with it later. One of the things we do everything on a fixed fee for businesses. So you have your cost. You know what it's going to cost you for 1 year's service. So we tell the clients, you need to call us. We want to communicate with you, because the more we know about you and what you are doing and what you have going on, the more we can try to add value and have impact that's going to get you further ahead and further towards your goal. So I'm a big believer in communication.
And Dan, now my only hesitation is, am I the person calling or emailing too much? So I like hold back. But after this conversation, I'm going to send more emails.
You just opened up a can of worms here.
Well,
that's all good. It's all good.
But I mean, look, the reality is based on your needs is what your fixed fee is, right? So if I have 25 rental properties and 5 businesses, my fixed fee is going to be higher than somebody that just has, one business and no rental properties. It's pretty obvious that's the business process.
And we try to be very open about the pricing model. I just tell people, look, if we get to a point where we're spending more time, we're just going to have an open conversation with you that says, hey, here's what we're doing. Hopefully you're finding value in this, and we think we can do more of it that will provide you more value, but we need to change the fee structure. Some of my largest clients today started as a very small fixed fee client, and as they realized the benefit of regular communication, they've grown their company substantially, which has been wonderful for them, and they've grown their relationship with us, which has been wonderful for us. So it's often a win-win when we're communicating more, because everybody's getting value and seeing how we can grow together.
Yeah. And Dan, I should add that I just increased my service set with them, because I cannot stand looking at QuickBooks and the confusion I have between all my accounts and moving money and classifying money. So I went to them for a quote on the bookkeeping, and they're doing all that now for me for multiple businesses. I am so I literally have an entire binder here on my desk of all this accounting stuff I was trying to do for bookkeeping. And it's just not me. I'm not a numbers guy. So I just turned it over to them. Matt, I wanted to go back to something you said just in the mix of something. I caught on to it, but I'm not sure if it's something that the listeners need to know. You had mentioned something when we were talking about the sale of the property and possibly having a tax bill or buying a property or whatever it was. And you said you need to know what your net is. Is that something that the listeners need to know about? What is a net? Is that just a slang or is that an actual thing? What is that?
It's probably my slang. So when I say net, what I mean is net of what I owe the bank and net of what I owe the government. Those are typically, when you're selling something, two of the other interested parties in the transaction. So you want to understand, okay, what's my sale price? What's my cost basis? Because that's going to determine my taxes. And then what do I owe on a property? Like real estate's a very good example. You can borrow against real estate more than one time if you've owned a piece of property for a long time. So a lot of assumptions that a client may make when they're selling a property is that, well, if I'm selling it for $500,000 and I owe $250,000, that my gain for tax purposes is $250,000. The liability has nothing to do with the tax calculation. If I've owned it for 30 years and I bought it for $100,000 30 years ago and I've depreciated it to zero, but I've borrowed on it 3 or 4 times over that 30 years that I've owned it and I sold it for $500,000 and I owed $250,000, the calculation of taxes is on $500,000 and the loan is $250,000. You might not get much cash out of that transaction. That's the net. You want to understand how the tax calculation may be different from what you owe the bank, because basis and debt are two very different things. Basis is what you pay for something. Yeah, you want to talk about surprising someone when they think, hey, well, I only owe $250,000, I got to pay taxes on the other $250,000 and I'm good. It's not that simple.
Matt, I keep seeing these little light bulbs appearing over your head.
So I think one of the reasons why I wanted to have Matt Zepka on is because for years I worked with an accountant, not a CPA. And he clearly told me he was an accountant, not a CPA. But the thing is like, these are value bombs. These are, even though I might not have a property that's got the 250, the 500, the 30 years I've owned it, depreciate it, and all the things he's talking about. There's something in there that's relevant to me in the fact that I'm learning something about how, like, you could sell that property and not walk away with any money. That's dumbfounding to me that you could own a property, sell it, have to pay the bank and pay the taxes and literally not have, hardly anything to show for it at the end of it. Because then why the point of selling the property, right? And so I think that's so important to have those conversations, to figure out, okay, because I think the conversations are about what are your goals and why do you want to do this? And then what are the tax implications and what do we owe? And let's run some quick spreadsheet numbers and things like that. These are all things that matter. But yet emotionally, most people are just doing the transaction, whatever that is, and feeling like, oh, they're going to walk away with $100,000. And they're not. They're just not.
Yeah, you have to understand it. I mean, in that scenario, if they remortgage the property, they likely have another asset that they own. So let's say they borrowed the $250,000 that we talked about to buy free and clear another piece of property. So they need to understand the cash part of that transaction. They need to transfer the loan to the property that they currently own from using the refi cash out that they did, so they can walk away with some money. So they got to get the bank on board with that. You always want to make sure the bank has a vested interest in real estate when you have loans. So you always have to get their approval with what you're doing. If you're trying to pull cash out, you just need to understand where it's coming from and why. So in that scenario, it's not that they were to a detriment because they probably added to their portfolio or bought another asset or did something of value, but because of the way they structured it, they're thinking something's going to come out of a sale transaction that might not be there. And that's really critical. Control, especially when it comes to taxes and understanding where, everybody says cash is king. Well, where do I get my cash? How much do I get to keep? And then where am I going to store it so that I have access to it and I can continue to use it in this process and make sure that I'm making the best decisions possible.
This whole conversation just breezed by. And honestly, taxes, to me, they're not the most exciting thing. I got a D in accounting when I was in college. So that's why I hire other people to, just like Matt Ward said, stick with what you're good at. I hire people to do all my data, enter things into QuickBooks, everything like that. But this was fascinating, and it was amazing to learn that by planning and preparing, that you can be ahead of the curve. And that's where you want to be, is ahead of the curve. So this flew by. Matt Zepka, how do people get in touch with you, your firm, and find out more about you and what you do?
Absolutely, yeah. Alicia Kovac in our office really handles all incoming communications, whether it be clients or prospects. Our office phone number is a great place to reach her, 269-492-7220. Or you can find her email on our website, which is valleyoakcpa.com, just spelled out. So those are probably the two best ways to reach her. If you've got questions, you're talking about tax planning, you want to schedule an appointment, she can walk you through all of that, tell you how it works, and then get something on the books to start having that first conversation.
Awesome.
Thanks so much for joining us. I love the energy that you bring to the game of taxes. It can be a boring conversation, but you are so incredibly invested in it and the success of your clients. I've seen that from the day I started working with you, from actually the day I saw you on a webinar. So to those business owners out there that might say, I'm not going to do webinars, they might not be worth it. Matt did a webinar that I was watching, and off of that webinar, I hired him and moved my businesses to his services and have been very happy ever since. So I would highly recommend people check out Valley Oak CPA and the team over there. They've been very attentive to my needs, and that is an understatement.
Well, I greatly
Thanks
appreciate
for coming
that.
on the show.
Yeah, my pleasure to be here. It's always great to talk. And, I always joke, if you ever saw Good Will Hunting and the old adage of how they asked Matt Damon, I could just play. Taxes, that's me. I see this menu in the sky, and I meet people and I talk to them, and I've figured out this way to talk about it that hopefully is more exciting than more boring, because it can be extremely boring if it's the wrong conversation. And it's not, especially when you can start to see how it can put money in your pocket. So happy to be here, guys. Great conversation. Thanks so much. Truly my pleasure.
Hey, Matt, what's your Yahoo moment?
Dan, my Yahoo moment today with Matt Zepka. Great guy. Play by the rules of the game that you're playing. And if you don't like that, change the game. And his reference was to switch the game up from football to baseball. But I think it's a matter of also knowing what game you're playing and the rules within that game. And he was referencing that related to the type of entity a business is and why you might want to change that up and the different tax rules around that. The reality is you can't get the rules, and you can't even get the game that you're in unless you're talking to the right person. So get an advisor, whoever that is, whoever you're comfortable with, whether it's them or somebody else, and start having conversations about the game that you're playing and the rules that are part of that game.
Right.
What about you, buddy?
Mine was, it's all about planning and preparation. And a lot of times people look at taxes as a one-time thing that happens April 15th. They'll drop their stuff off to the accountant, and then they won't think about it, and then they'll get these huge tax bills. But planning and preparation, two ways: one, financially, and two, what your goals are. And people forget about it sometimes. Planning what your goals are for your business is just as important as planning financially for your business, because then you can start to project and you can start to plan for what it's going to be and what it's not going to be. And take it from me, it's awful to be behind the curve with taxes. You always want to be ahead of the curve, because it can be like this dark freaking cloud hanging over your head. So clear that cloud up, get ahead of the curve, plan, prepare, and play the game.
You just listened to the SPRH podcast with Matt Ward and Dan Candell, where you learn from the pros how to take massive action. Remember, have yourself an action-oriented day.